The longer-term economic outlook, however, remains uncertain. Weaker household consumption and falling property prices may be a drag on growth for a sustained period. Climate change and geopolitical tensions threaten supply chains, output, and prices. With high interest rates and uncertainty, financial markets and asset prices are expected to remain volatile, dampening investor appetite and capital flows. Taking these and other factors into account, the SAP's forecast for global growth in 2023 is broadly unchanged at 2.7% and 2.6% in 2024. While South Africa's electricity load shedding has declined, domestic growth in the near term is likely to remain muted. Energy and logistical constraints are still binding on economic activity and generally increase costs. We, however, expect electricity supply to increase gradually over the medium term, helping to raise our forecast for output growth in 2024, 2025, and 2026. Spending by firms, households, public corporations, and general government remains positive in real terms on an annual basis. Disposable income of households is expected to grow, albeit slowly. The investment forecast for the year was revised up to 7.7% in September. Credit growth to households and corporates has slowed in recent months, but remains positive. GDP growth for 2023 is revised slightly upward to 0.8% from the September figure of 0.7%. Our GDP growth forecast for 2024 and 2023 is increased from the previous meeting to 1.2% and 1.3% respectively, in large part due to an expected decrease in load shedding. While households and firms exhibit some resilience, economic growth has been volatile and highly sensitive to new shocks. A sustained reduction in load shedding or greater energy supply from alternative sources would significantly increase growth. The operation of ports and rail, however, have become a serious constraint. At present, we assess the risks to the medium-term domestic growth outlook to be balanced as demand continues to run ahead of the constrained supply environment. As a result, our current growth forecast leaves the output gap marginally positive. Turning to the inflation outlook, South Africa's headline inflation rate has increased more gradually than in many other emerging and advanced economies. Nonetheless, South Africa's inflation rate remains sensitive to shocks. While volatile in recent weeks, oil prices have increased over the year and commodity export prices have moderated further. South Africa's external financing needs will increase as the current account deficit expands from a forecasted 1.3% of GDP this year to 2.6% of GDP in 2024 and to 3.5% of GDP in 2025. The smaller deficit this year is the result of significantly better than expected trade outcomes in the third quarter. The rand weakened over the past year, depreciating by about 9.5% against the US dollar. The lack of sustained economic growth and dependence on commodities is reflected in the high volatility of the currency in response to global risk-on and risk-off episodes. The implied starting point for the rand forecast is 18 rands 76 cents to the US dollar compared to 18 rands 45 cents at the time of the previous meeting. Compared to September, fuel price inflation is broadly unchanged for 2023, but lowered from 5.8% to 3.2% in 2024. Our food price inflation forecast for 2023 remains high at 10.6%. The forecast for 2024 is slightly higher at 5.5%. Better monthly outcomes have led to a marginal downward revision in our forecast for core inflation to 4.8% in 2023 and to 4.6% in 2024. The core inflation forecast for 2025 remains at 4.5%. The new 2026 core forecast is also 4.5%. Services inflation in 2023 is now expected to come in at 4.3% before rising to 4.8% in 2024. Core goods inflation remains elevated, but is revised lower for this year to 6%. Growth in average salaries and unit labor costs is forecast to be somewhat lower than at the time of the September meeting. With few significant changes to underlying components, headline inflation for 2023 is revised down slightly to 5.8%. The forecast for headline inflation for 2024 is 5%, before stabilizing at 4.5% in 2025 and 2026. While our baseline inflation forecast has improved, risks to the inflation outlook are still assessed to the upside. Even as global headline inflation moderates, oil markets remain tight and core inflation sticky. Despite recent easing in some food price components, domestic food price inflation remains volatile and increased in October to 8.7%. El Niño conditions present longer-term concerns. Imported goods inflation has increased over the year, and despite slightly better recent outcomes, remains sensitive to currency weakness. Electricity prices continue to present clear inflation risks, and with logistics constraints, are likely to have broader effects on the cost of doing business and the cost of living. Given uncertain food and fuel price inflation, considerable risk still attaches to the forecast for average salaries. Sticky inflation implies that average policy rates in major economies will remain high at about 4.3% in 2024 compared to the 1.1% average rate in 2022. These tighter global financial conditions will raise the risk profile of economies needing foreign capital. Sharply lower tax revenue, higher employee compensation, and ongoing financing needs of state-owned enterprises are expected to keep South Africa's long-term cost of borrowing elevated. Despite an expected moderation in inflation, long-term bond yields currently trade around 12%. Higher inflation has generally resulted in elevated inflation expectations across markets, businesses, and households. Market-based expectations for inflation in 2023 are currently at 5.8%, while near-term break-even rates have dipped to 4.3%. Medium and longer-term market expectations for inflation remain elevated. The September survey of the Bureau for Economic Research shows average inflation expectations lower at 6.1% for 2023. The committee, however, would prefer to see the expectations anchored at the midpoint of the inflation targeting range. Against this backdrop, the MPC decided to keep the repurchase rate at the current level of 8.25% per year. The decision was unanimous. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and elevated inflation expectations. Serious upside risks to the inflation outlook remain. In light of these risks, the committee remains vigilant and stands ready to act should risks begin to materialize. Decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The inflation and repo rate projections from the updated QPM remain a broad policy guide, changing from meeting to meeting in response to new data and risks. The policy stance aims to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations.